we have seen historical return or actual return, how we can calculate the actual return when the stock price is traded in the secondary market. And we looked at the holding period return. The holding period return, we call it the total return. We calculated that. So how we calculated? Dividend plus closing price minus opening price divided by opening price. When you multiply with 100, you will get the total return. Then we have seen how to calculate the arithmetic mean or average return, how we can calculate. That will give you the total average return over the period of time. Then we have calculated the geometric mean to find out the compound rate of growth. What is the compound rate of growth over a period of time? So that we have calculated by using geometric mean. And then today we are going to look at the second component, the risk. So we cannot talk about return without talking about the risk, because risk and return are two sides of the same coin. Now look at this particular figure, what is given there. A story of two stocks. So look at this stock's return. It is given there in the graph. It is highly fluctuating. And then look at the second graph. 1 minute. Second graph. Look at this. Okay. Then the same return, we have put it in a table format. Look at that. Okay. So stock M and stock N over the 5-year period return is given, and the average return is 31%. So now, which stock we need to buy? That is a question. So when we look at the return, average return is 31% for the past 5 years. Now, which stock we need to buy? So look at that. Look at this particular graph. Okay, the investment A return is increasing in comparison to investment B. So the obvious choice is investment A, because investment A stock return is higher than investment B stocks. And look at this figure. Now we are adding the risk element in this particular graph. So risk of a particular stock A is fluctuating, whereas the risk of a particular stock B, it is steady, it is consistent. The return of a particular stock A is fluctuating, and the return from stock B is steady growth. So which one we need to choose? So when we compare the previous graph, we wanted to choose stock A. Now when we take up the second graph, we wanted to choose the stock B, because stock A return is fluctuating and stock B return is consistent. So when we integrate a risk element with particular return, so certainly we can take a proper decision. Now we need to see what is risk, how do we measure the risk. So this particular session outcome is today is how we can compute risk and how we can measure the risk. So before we wanted to know how to compute the risk, we should know how do we measure the risk, and at the same time we need to know what is risk. So this is the financial pyramid of various asset classes. In terms of risk, it has been classified. Look at the base of the pyramid. The base of the pyramid is the cash equivalents. That is, it talks about the bank deposits. So it's the bank deposits. So bank deposits are having lower risk, and come to the bonds. So bonds or debentures relatively higher risk in comparison to the bank deposits. Then mutual funds. Then it moves the stocks and real estate relatively higher. And we talk about the financial derivatives instrument, futures and options, which are called speculative investment tools. So when you look at this at the bottom of the pyramid, the return is very less. So when you invest in bank deposits, the return is relatively less. So when the return is less, the risk is also less. And moving to the top layer, next layer, it is called bonds or debentures. return is relatively higher than bank deposits. The debentures offer higher return than this bank deposits. So bank deposits say it is 9.5%. Debentures offer 11% or 12%. Then moving to the next level, that is third level, that is mutual fund, relatively higher return, assuming higher risk. Then next layer is stocks or real estate, which gives you higher return, and we'll have to assume the higher risk. Then when we go for speculative tools, that is called financial derivatives, which may offer a higher return, but we need to take up the higher risk. So this is what the risk return relationship of various asset classes. Lower the risk, lower the return. Higher the risk, higher the return. So cash equivalents, what we meant here is the deposits in the bank or cash that we have, which offers low return, and which is also having very low risk. Then next level, bonds, international bonds, real estate, stocks, and international stocks. So when you assume higher risk, certainly the return is also increasing. So this is what we call it risk return relationship between various asset classes what we have. So based on the risk, we can classify all the investors can be divided into three broad categories. One is conservative investors, moderate investors, aggressive investors. Conservative investors, moderate investors, aggressive investors. So who are called aggressive investors? Aggressive investors who wanted to assume very high risk and they want to get very high return. They are called aggressive investors. So aggressive investors, I want to get more return, but I am ready to assume more risk, then I may be called aggressive investor. So aggressive investors are having too much investment in stocks. They want to have a higher potential for growth, and they wanted to take up any kind of market volatility. And what is more important is there is no guarantee that you will get back the principal amount that we have invested. Sometimes we'll have to lose our principal amount also. When we take the example of S-Bank, it was in mid-level stocks. It's called mid-cap stocks. And when the S-Bank had a lot of financial manipulations and the S-Bank was in a deep trouble, it was trading below the face value. It was trading below the face value. What I meant is below 10 rupees. So below 10 rupees it was trading. Now currently it has gone up because SBI, as State Bank of India, has taken up the stake in S-Bank. So after that, the S-Bank stock prices have moved up. But I was talking about the beginning stage when Rana Kapoor, the MD, was caught, and the entire bank was in trouble at the mid of January 2020. Then the stock price was going below rupees 10. So sometimes investors may lose their own principal payment in case of aggressive investors. Conservative, highly opposite. They don't want to take a very high risk. They want to assume very low risk, but at the same time the return will be very, very low. So where do they invest? They tend to invest in cash, bank deposits in commercial banks, or they want to invest in bonds, or they may go up to the mutual fund level. They don't go to the stock level, next level. So the conservative investors, their investment may be up to the mutual fund level. So what is the bottom of the pyramid? Bottom of the pyramid is the bank deposits, next level is bonds, then the third level is mutual funds, the fourth level only the stocks. So the conservative investors may not go beyond mutual funds because they wanted to assume very low risk. Now, so the risk is, now we need to know how to reduce risk. So we can reduce risk only through portfolio diversification. The concept of portfolio diversification we will see in detail when we take up a portfolio theory, which talks about portfolio diversification. So the same thing what we have discussed earlier when we talked about portfolio, instead of keeping 10x in one basket, the likelihood of breaking is very, very high. The same way, if you keep 2x in 5 baskets, the likelihood of breaking is very, very less. So that's what we call it diversification of stocks. So instead of investing the entire 1 lakh rupees what we have in one particular stock, we'll have to invest that 1 lakh in 10 different stocks. So if we invest in 10 different stocks, 10,000 rupees each, the risk will be minimum. So we cannot reduce risk, we cannot eliminate risk, we can only diversify or we can only reduce our risk. The risk elimination is possible, the risk reduction is possible only through portfolio diversification. So we will see in detail what is portfolio diversification later on when we take up the portfolio theory. So this is what I just wanted to give an introduction about risk. Then now I just want to take you through what is risk, and how do we measure the risk that we'll take up next one. Yeah. So look at this. Now what is risk? All of us know the return and risk are closely related. Risk and return are inversely related. Closely related, inversely related. And we cannot say inversely related. It is, we can say, that is a direct relationship. So there is a direct relationship between risk and return. Direct relationship, what we meant is, higher the return, higher the risk. Lower the return, lower the risk. Now, what do we mean by risk? The risk means the deviation from the expected return. Deviation from the expected return. So, for example, you expect at 15%, but the stock gives you 12%. So that is a deviation. So that deviation is called risk. Or we can say variability in return. See, look at these two examples. Look at the two examples here. The return. So one, the return is, I'm just writing here. Okay. Okay. So this is one type of return. First year, second year, third year, fourth year, fifth year, sixth year, seventh year, eighth year return. Okay. Second, we have, okay, second return. First year, second year, third year, fourth year, fifth year, sixth year, seventh year. Okay. Eighth year. Look at this. 2 years return. So look at the two graphs. So which one is more fluctuating? Stock A, stock B. Which one is more fluctuating? Anybody?
Stock A.
Stock A is more fluctuating than the stock B. So stock A is more fluctuating than stock B. That means stock A is more risky than stock B. Stock A is more risky than stock B. That means higher the variability, higher the risk. Lower the variability, lower the risk. Or higher the consistency level is very high. Higher the consistency, lower the risk. Lower the consistency, higher the risk. Is that clear? So risk means variability in return. Risk means deviation from the expected return. Risk means consistency in relation to return. So variability is higher, then the risk is higher. The variability is low, the risk is low. The consistency is very high, the risk is low. The consistency is here, for example, stock B, the consistency is very high. Consistency is very high, the risk is low. Consistency is very low, the risk is high. So the risk is talks about uncertainty associated with the return on investment. So all the investment decisions involve the trade-off between the two. So you cannot, I don't want to take a more risk. In such case, you will have to take up only the lower return. So there must be a trade-off between risk and return. So risk refers to the possibility of their actual outcome of an investment which will differ from its expected income. That means what is a deviation from the expected return? The deviation of the expected return is higher, then the risk is high. The deviation of the expected return is low, the risk is low. So this means that more variable the possible outcomes that can occur, the greater the risk. So the risk refers to variability. So if an asset return has no variability, the risk is less. The risk means the variability. Is that clear? Anybody? All of you understood what's the meaning of risk? Because with this particular concept, we need to be very clear. The risk concept must be very clear. So risk means variability. The higher the variability, higher the return, higher the risk. Any clarification regarding the concept called risk? Now, what is the source of risk? Where does the risk come from? Where does the risk come from? The risk comes from external sources. The risk comes from internal sources. So it can be external or it can be internal. So the factors which are external are called systematic risk. The factors which are external is called systematic risk, or the factors which are uncontrollable, it is called systematic risk. So any company which comes for starting the business, this particular risk is default for any company. So systematic risk is also known as market risk, or we call it as, 1 minute. So the risk equal to systematic risk plus unsystematic risk. So systematic risk means the factors which cannot be controlled. It is beyond the control of the company. So any company which starts in the business, which starts a business activity, that particular business has got this particular risk. So this risk, systematic risk, is also known as market risk. So this particular risk is also known as non-diversifiable risk. Non-diversifiable risk. So systematic risk, we cannot diversify. The moment we start investing in stocks, so this particular risk is default. So we can also known as, we can also call as default risk. So non-diversifiable risk, systematic risk, market risk, default risk, all having the same meaning. So the risk which is beyond the control of a company is called systematic risk, or we call it non-diversifiable risk. So this risk cannot be eliminated. The moment we start business, this particular risk is always there. We cannot eliminate this particular risk. So that is why any mutual fund company, when you talk about one particular class is coming, what is that class? Anybody can say? Always the mutual fund companies advertisement comes, one particular class comes. What is that? Anybody can say? Anybody? Can you read that particular sentence? I mean, one sentence usually comes. What is the sentence called? Your investments are subject to market risk. Market risk. So what do they refer to that market risk? This particular risk. So this particular risk only they are talking about. The advertisement, see, always you would have seen in a cigarette packet, smoking is injurious to health. So that is a statutory warning. Statutory warning, they'll have to put it. So same way, when any mutual fund company comes for an advertisement, so this statutory warning is always there. That means at any point of time, so you may tend to lose your investment because your investments are subject to this particular market risk. No company can eliminate this particular risk. No company can reduce this particular risk. That's why it is called non-diversifiable risk. That's why it's called default risk. The moment we start company, we start with this particular risk. The moment we start investing, we start with this particular risk. Is that clear? So these are all some list I have put it. I have added the last point, COVID-19 pandemic also I have added. So no company can eliminate this particular risk. So what's the relationship between COVID-19 pandemic and the IT company? All the companies are getting affected throughout the world. Throughout the world, all the companies are getting affected. So this particular risk is called systematic risk. This particular risk is called the market risk. So in the new textbook which is going to come, so this particular factor also they will add. So I have added now itself. Yesterday itself I have added. So when we take up the class, because the new textbook which is coming, so they will add this COVID-19 pandemic. So no company can reduce this particular risk. Okay. So these are all certain factors which contribute to systematic risk. War and other calamities, major changes in tax rates, decrease or increase in inflation, change in economic policy, change in monetary policy, industrial recession, that is a contraction in industrial activity, decrease in international oil prices, and currently what we are facing is COVID-19 pandemic. So these are all the factors which every company are subject to fall under this particular risk factors. Okay. Now, this systematic risk can be classified into three broad categories. So systematic risk, the total risk is equivalent to systematic risk plus unsystematic risk. Now we are talking about systematic risk. So what is systematic risk? So systematic risk is a combination of market risk. Systematic risk is the combination of market risk plus interest rate risk. Interest rate risk, plus purchasing power risk. So all these concepts are there in your LMS. I don't want to read what is there in study material because study material is given in the LMS. You can just download and see. I'm just giving explanation so that when you read and if there is any clarification, you can always ask in the next class. It's already there. All this explanation is there in the LMS. Now, what is called market risk? The market risk, what we talk about is the demand and supply. Demand and supply of stocks on a particular day. So demand and supply of a particular stock, no company can have a control over that. No company can have a control. Can I reduce my demand? No company can reduce their own company demand on a particular day. So on a particular day, demand and supply forces, no company can have a control over it. So that is called market risk. The demand is more, we call it bull. The demand is less, we call it bear. So that's what we call it, bull forces and bear forces. Bullish and bearish market conditions. So this bullish and bearish market conditions, companies cannot have any control over it. So higher the demand than the supply, the stock price will increase. Lower the demand than the supply, the stock price will fall. So this forces, these bull bear forces, companies do not have any control over it. So that is called market risk. So market risk is called bull and bear. That is demand and supply of a stock on a particular day. On a particular day, what is the demand and supply of a particular stock? That no company can have a control over it. Then second. So second is interest rate risk and purchasing power risk. Interest rate risk, purchasing power risk, all these risk factors are depending on monetary policy of central bank. Monetary policy central bank, all of us know, you would have studied in economics, microeconomics and macroeconomics, managerial economics, you would have studied very clearly what are those monetary policy exercised by the RBI of our country. So today, you would have seen on May 22nd and post May 22nd and April 3rd week, RBI governor came to media. And then May 22nd also he came to media, to reduce the inflation and enhance the demand. So what he did, he has reduced the repo rate. Last year, when you look back in January 2020, the repo rate was 5.4. Now today, what's the repo rate? 4%. The repo rate today is 4%. Repo rate today is 4%. It was 5.4, reduced to 4.4, and May 22nd, from 4.4, he reduced to 4. Why does he reduce repo rate from 4.4 to 4? Why does RBI governor reduce repo rate from 4.4 to 4? So he reduced 40 basis points. So always whenever RBI governor talks, he talks in terms of basis points. So please remember, 100 basis points is equal to 1%. 100 basis points, 100 basis points is equal to 1%. 100 basis points equal to 1%. So he reduced 40 basis points. So when he reduces 40 basis points, how much percentage? 0.4%. Okay. So he reduced 40 basis points. 40 basis points. So 40 basis points means what? 0.4%. So he reduced from 4.4% to 4%. So current repo rate is 4%. So why does RBI governor reduce repo rate? Any thought?
Sir, to enhance the cash flow in the economy.
To enhance the cash flow in the economy. Good. To enhance the money supply in the economy. Because the economy is reducing. We are in, all the companies are standstill. No companies is functioning. Demand becomes zero. So how does RBI enhance the demand? So this is a monetary tool they have. So what they can do? So all of us know what is repo rate. What is the repo rate? The rate at which RBI lends money to commercial banks. The rate at which RBI lends money to commercial banks. So when the rates have reduced, that means that the commercial banks can borrow more. The commercial banks can borrow more from RBI. So when they borrow more from RBI, because the rates have come down, so they can borrow more. So when they borrow more, and the retail borrower, when we go to bank and when we ask for a loan, so you can get more loans. That means what I meant is the companies can get more loans from the commercial banks. So the lending increases because the rates have come down. So the lending increases. Why? How the lending increases? The lending increases because the repo rate comes down, and consequently the rates by commercial banks also have come down. The lending rates of commercial banks will also come down, so you borrow more. So when the companies borrow more, the investment increases. The company's investment increases. When the company investment increases, the production increases. When the company's production increases, certainly, the supply increases. Good supply increases. So when the good supply increases, certainly the demand of the particular product increases. The demand increases, certainly what happens is we buy more. And for the retail investors, when we go to the bank, you can borrow more. Why? Because the banking lending rate will come down. Why does the bank reduce the lending rate? Because their borrowing rate has come down. The repo rate has come down. So we can borrow more. So when we borrow more, the money supply increases. When the money supply increases, we buy more. The demand increases. So ultimately, the reduction in repo rate increases the demand. The current important factor today is to increase the demand of people. So how does the central bank increase the demand of the people? Reduce the repo rate. So this is what the cycle. So this cycle takes. We have completed discussing about within 5 minutes. We can discuss about the entire concept. But this cycle, the real situation, it takes minimum 6 months. This particular cycle, what I'm talking about, you can borrow less, decrease the borrowing rate. Their borrowing rate should be reduced. So how their borrowing rate can be reduced? by reduction in report. So these are all interrelated. So interest rate risk and purchasing power risk are closely related. So any clarification with regard to market risk, interest rate risk and purchasing power risk. So these risk factors, no company can have control over it. So it is called non-diversifiable risk, default risk, or we call it market risk, or we call it systematic risk. Any clarification with regard to systematic risk? Anybody? Any clarification? Anybody? Anything anybody want to ask? Anybody? Any clarification? Anybody? With regard to systematic risk? All of you are clear?
Yes, sir.
Is it clear? Yeah. Next one is unsystematic risk. Unsystematic risk, or we call it diversifiable risk, or we call it controllable risk. The previous one is uncontrollable risk. This is called controllable risk. So this is subject to a particular company. It is subject to a particular company. What happened in Yes Bank now? So Yes Bank is in great trouble because of the financial manipulations, because of the fraud which has been taken place the past 2 years. So this is related to a particular institution. It's related to a particular company. So these particular risk factors, the companies should have a responsibility on it. Okay? The return from a security may sometimes vary because of certain factors affecting only a particular company. So that is called unsystematic risk. So this is broadly classified into two broad categories. One is business risk, another one is financial risk. So what are the factors contributing this particular business risk and financial risk? Raw material scarcity. So every company now are having this raw material scarcity because of the money. Supply chain is greatly affected. So lack of raw materials availability, labor strike, management inefficiency, death of a key company officer. A key company officer has left the company, and unexpected entry of new competitors into the market. All these are all factors which contribute to a particular company. Quality machines are not available. So if you don't have a quality machines, you cannot have a standard production, or sometimes quality manpower the company may not have. So these are all the factors which affect a particular company. So these risk factors are classified into two broad categories. One is business risk, another one is financial risk. The business risk related to all the factors, that is raw material scarcity, labor strike, management efficiency, death of a key company officer. These are all which affects the entire business of a company. That is called business risk. Financial risk relates to the leverage of a company. That is how a company employs its debt and equity. So you would have studied the company need to have more debt, because debt is a cheap source of funds, because debt has got tax advantage. So what is tax advantage? Before the company pays the tax, the interest on loan the company can reduce. So the more the interest company pays, the less the tax the company pays. So that means the more debt is there, the less the overall cost of capital will come down. So it relates to the leverage of a company. So how the company employs debt in a capital structure. The more debt the company employs, certainly the company need to assume more risk, because debt debt instruments have got the fixed payment, that is called interest. At the same time, the company need to pay the principal amount back. But the debt is a cheaper source of funds. So how much of debt is involved in a capital structure talks about financial risk. So financial risk is a leverage risk, that is employment of debt in a capital structure. So the unsystematic risk is a combination of business risk and financial risk, which is controllable by the company. So it varies from one company to another company. So now, how do we measure each risk? So we'll have to measure the systematic risk and we'll have to measure the unsystematic risk. So systematic risk, how do we measure? There must be a tool. There must be a tool which is available to measure systematic risk. And how do we measure the total risk? The total risk can be measured through a standard deviation. Total risk is measured through standard deviation. And systematic risk is measured through beta. So we need to know how to calculate standard deviation and how to calculate a beta. So any clarification till now? So we talked about the basic concept of risk and the relationship between risk and return of various asset classes. And then we have seen the concept of risk. The risk refers to variability of return. Then we talked about the total risk. The total risk is the combination of systematic risk and unsystematic risk. We call it non-diversifiable risk and diversifiable risk. And then what is called systematic risk? Systematic risk is a combination of market risk, interest rate risk and purchasing power risk. No company can have a control over these systematic risk factors. Okay. The recent factor is the COVID-19 pandemic. No company can have a control over it. Second element of risk is called unsystematic risk, or we call it diversifiable risk, or we call it controllable risk, or we call it specific risk. Specific risk. Okay. So this depends on a particular company. With the company factors contributing the particular risk factor. So it's a combination of business risk and the financial risk. The business risk is the total risk related to a total business operations of a company, and financial risk relates to the leverage risk, or we call it element of debt in the capital structure. Any clarification? Now we'll have to move forward, measuring the risk. How to measure, how to calculate the risk. The risk is qualitative in nature. Risk is qualitative in nature. Okay, it's like honesty, integrity. So how do we measure the honesty of a person? We cannot. We cannot measure the honesty of a person. We cannot measure the integrity of a person. These are all qualitative characteristics. But in finance, we cannot talk about qualitative characteristics without measuring it. We'll have to measure it. We'll have to specify in numbers. So how do we quantify that qualitative characteristic? We'll have to use certain statistical tools. So we have two important statistical tools here. One is variance, or we call it standard deviation, and another one we have beta. So standard deviation is used for measuring total risk, and beta is used for measuring systematic risk. Okay, so unsystematic risk we cannot measure because it varies from one company to another company. It varies from one company to another company, so we cannot measure it. But if you take one particular company, we can measure it. If you take, for example, research topic, we are taking a few companies. So when we take few companies, we can able to measure the unsystematic risk factor also. Okay. So in our deliberations, we look at standard deviation and the beta. So before we proceed with the measurement of risk, anything anybody wanted to ask? Yes, yeah.
Sir, I don't know if at all this is correct or not, but I have heard that in securities market there are certain funds that we cannot advertise, and also particularly there would be any statutory awareness which would be given. As per the government norms, like where high net worth individual invest, certain funds cannot be considered to have advertised. Is it true or not?
No, all the funds, you're talking about mutual funds or?
Sir, other than mutual funds, like when we move into alternative investment funds, certain funds cannot be advertised.
Alternative investment funds, we know what are the example?
Sir, hedge funds, private equity.
Hedge funds, yeah, hedge funds, private equity, these are all related to a particular company. As an individual, we cannot invest. It is not related to retail investors. it is not related to retail investors. It is only for companies. So among the companies, there is a advertisement, there is the information dissemination, all that will happen. Yeah, but it is not related to these private equity funds. For example, now what Reliance Jio has done. Reliance Jio has done, how many investors are invested current for past 7 weeks? 7 investors have invested. 7 investors, and even including last 3 days before, one more private equity investment they are invested in Reliance Jio. So including that, they had 7 investors, 7 private equity investors. Correct? So it is how it happened. It is because of the deal between the company and the investor. So they first of all they present, whoever is started willing to invest, they just come for first of all they come forward, and the company will make a presentation, because you might have seen the company MD, the Reliance Jio MD, his name is Manoj Modi. His name is Manoj Modi. So Manoj, because of him only, it is because of his personal capability, it is because of his personal competence, the company went forward and taking up this money, 85,000 crore they got investment. Okay, so they start negotiating, and finally the deal takes place. Okay, so first of all the company will send a different notification to different potential investors, because we wanted to have investment. They will send a notification, and then they will send a different potential investors. They will send a complete details about the company. They advertise about the company, and then private equity investors will come forward. They'll sit for a deal, and they'll finalize it. It happens between the investor and the company. Got it, Jimin?
Yes, sir. Thank you so much, sir.
This is what it happens. Now, currently, today, I don't know if you've seen or not, Lakshmi Vilas Bank, is it today's news? Lakshmi Vilas Bank, it's a cash debt-ridden company. Lakshmi Vilas Bank is a private bank, and that particular bank requires investment. A private equity investor today, he came forward for investment in Lakshmi Vilas Bank. Okay, so how did it happen? The bank would have approached privately to various investors, because bank requires cash. They require liquid cash now. They would have approached these investors privately, and the investor came forward. Okay, so like this, people should ask relevant questions. For the sake of asking questions, then you will be caught. Okay, thank you. Thank you very much. We will meet next session. Thank you.